So here's where we're going to go deeper into Asia and the emerging markets. And now this segment is going to be a little bit longer than some of the others just because there are a lot of new data sets in general. And one of the updates we wanted to provide is, again, looking at the Chinese-Indian border. And you can see the Twitter handle down here, which is, I think this individual is, or a group of individuals, is an absolute must follow. The data, the pictures are fantastic. And one of the things that we've been talking about is the discrepancies or the issues that remain between the Chinese and Indian military. And as they continue to try to negotiate for essentially the winter months, there's a lot of movement on both sides. And this is just looking at how India has responded to some of the recent buildups on the PLA or the People's Liberation Army or the Chinese side. So recent imagery of Thos Air Base and Ladakh reveals the deployment of fighter aircraft on site, which have been deployed since late 2020, which is part of the India's China face-off, as the air base itself plays a critical role in boosting India's air power in the region. So this is where we haven't seen any de-escalation. And I think that's the biggest point here is we've actually seen a movement, more movement, and this is both sides. This is not just one-sided. Both sides have responded with moving new personnel and equipment. Now, they're not at the front line. So to be clear, they're at fallback positions or support positions, but we've seen these amass. And again, it doesn't take long to move them to forward operations. But this is something where they're preparing for the worst. They're preparing for, okay, if these talks really go nowhere and we start to see this tit for tat escalation, both sides are going to be able to respond, which again is going to become a much bigger issue when you think about the stability of the region and what that means for not only just the South China Sea, but also the relationship between India and China, which is strenuous at best. So then when you look at how the U.S. fits in and the U.S. continues to move further on the Indian side, you see a lot of joint operations between India, Japan, Australia. And again, this becomes an issue for China because China has an LNG shortage. They have a coal shortage. And where do they source a lot of this? Well, Australia. So how are you going to replace Australia? Because they've tried to replace Australian coal. They can't. They're now beholden and buying more. All the while, Australia has been very adamant that, no, we support India. We're going to continue to support India. And again, these are some of those friction points that continue to come in. But now let's think about emerging markets, because emerging market inflation expectations are well above target as they continue to trend higher, which is, again, kind of tying in the very first segment. When you look at emerging markets, rates going up, well, they have to because inflation expectations are going higher. And then the inflation is coming in well above estimates, which is why when you look at the local currencies, they continue to worsen. So even though the dollar has gotten softer, other currencies have gotten worse. So the dollar's weakened, but they've weakened more. So even though the dollar's come down, we're seeing that overshoot to the downside, which is creating and maintaining these pressures, which is why emerging markets will be forced to and have been forced to raise rates and will continue to raise rates. So then when you look at that inflation shift, and this is looking at, again, the Citi Emerging Market Inflation Surprise Index, has continued to surprise to the continued to surprise to the upside, which again is creating that pressure point when you look at emerging market inflation and how it keeps escalating, which is going to become a bigger problem for rolling debt, getting new debt, increasing the debt level because you're going to ask for a higher rate. And that's going to put additional pressure as, China just issued $4 billion in US dollar denominated debt. And some of these things are, how can you afford dollar denominated debt? Because some people might say, look, I'm not borrowing in your currency. I'll borrow in dollars. But then as their currencies weaken against the dollar, it gets more expensive to maintain it, which creates those additional problems, those additional strenuous nature on the underlying economy, which they really can't tolerate right now, even as, and again, how do you offset this inflation? Well, maintain reserve currency. So how do you do that? Well, you buy US dollars. So when you look at reserve holdings by emerging market economies, you can see that they continue to rise because they're trying to offset that inflation fear by backstopping themselves with either more dollars, more treasury bills, even as China remains flat, which means that emerging markets are trying to allay some of those fears by increasing their holdings within dollars. So before we get bigger and deeper into some of these emerging market pieces, I think this was an interesting chart that I wanted to talk about of the top 25 economies with artificial intelligence patents. And you can see that the US remains at the highest level, but China has closed a lot of this gap since 2018 when this was struck. And we keep seeing them trying to come up because remember, Xi's target was to create more of this AI side. But now that you're starting to see a bit more of that communist push, the common prosperity, will we see people say, look, I have a PhD from Stanford or MIT or some sort of advanced degree in artificial intelligence. Are you going to go to a country that has a communist bent where you may not be able to make money on your patent, or will you go to a country that you can? So how much can China really walk into this, to walk back some of these benefits without seeing additional brain drain? Because before 2013, if you have a PhD in AI, you can punch your own ticket. You can go to any country you want, any company you want. It's a very highly coveted degree. It's hard to get. And again, it's something that people want and they'll pay for. So because of that, you can go anywhere in the world. Do you want to go back to China? If you're Chinese, do you have a drawback? Do you want to go to some other Asian nation, whether it be Singapore or Vietnam or Japan? Or do you want to go to Europe or the US? And these are opportunities which, again, has to be addressed because China can't push away because they've made so many strides to attract these individuals back into their country because this is a focal point for Xi and the CCP of increasing their technological capacity, becoming the driver of new AI innovation, not trying to adopt, recreate, or purchase AI innovation from someone else. And this is going to be that interesting balancing that they're going to have to manage as they try to increase or rely more on a communist view versus more of a free market view. And that's when you start looking at, well, China's also beholden to because they're energy importers. Because when you look at what are they importing, they import coal and natural gas. And prices have exploded. Now, they've also exploded after China made the announcement where the premier said, at all costs, which again meant more than just price. When you look at whether it be the value of life, whether it be the value of politics, but you've seen a big increase in those prices, which they've now come back and they said, oh, wait, what did we say? Oh, well, let's look at thermal coal futures where you've seen some of these coal futures come down because now the government is saying, whoa, we did not say at any price. We really meant, and now you're starting to see them step in and say that they're investigating collusion. They're trying to do things to offset, and then coal prices reversed lower. And depending on when you're watching this, they were limit down. Just because they now there's intervention, they can't let coal prices go that high. So again, that comes down to CPI versus PPI as we continue to talk about. But on the other side, you've also had some commentary on the Chinese high yield side looking at real estate. So in today's China Developer News, Sinac has technically defaulted according to S&P. Kaisa Management cancels creditor meetings this week. Evergrande's 30-day grace period could end as soon as Saturday. And then when you look at Chinese high yield, it's come down a bit just because there has been some movement in some other areas, but we continue to see defaults rising. And I think the Evergrande side is going to be the kind of that next shoe to drop to see what they do on those deliveries of that interest. What are we going to see a much broader default? And I think the answer is yes, because the risk of investing in China is increasing exponentially, and I think you're starting to see that play out. Now, when we look at the Chinese data that has come out, here you can see GDP quarter over quarter was expected at 0.4, came in at 0.2. Year over year was expected at 5%, came in at 0.49%. But when you look at retail sales, they increased from 3.5% to 4.4%. That is coming back down because remember, we had said August sucked, September's better, and now October is worse than September. So we saw, as we were saying, August was horrendous. And think about this critically, as we described. August issues, they had COVID increasing in cities. September, you had COVID cases increasing on the rural side. Now, in October, you have COVID cases increasing again in the urban setting on top of a much slower and weaker Golden Week. So again, retail sales are going to be worse in October than they were in September. Industrial production, not surprising, came in well below estimates. It was expected at 3.8%, came in at 3.1%. Fixed assets ex rural was expected at 7.8%, came in at 7.3%. Property investment expected at 9.5%, came in at 8.8%. Again, all of these are showing that 4.9% is just a lie. Like we're seeing such a slowdown, and Q4 is going to be worse than Q3 as they're moving in the wrong direction, as things continue to get worse, as new home prices actually went negative for the first time since 2015. All the while, it's important to appreciate that we're not seeing activity picking up. It's only going to get worse as credit impulses, or the annual change of adjusted total social financing, continues to be negative. And as we've been saying before, the PBOC injected money ahead of Golden Week and month end, quarter end, and now they've taken it all out and then some. So there's going to be that pressure point, and you're just not going to see a recovery. We still believe there's going to be that triple R cut, but at the micro SMID cap level, not a broad cut, just because they're trying to be more targeted in trying to drum up support for the micro and SMID cap businesses. But this is what we keep talking about when we look at the China PPI versus CPI. China's fixed asset investment grew 7.3% in January through September versus the expected previous. Then when you look at just where things are going, they're moving in the wrong direction. All the while, producer prices are just going higher and higher while the consumer price stays flat. So at what point do you just have to yield and pass this through? And the answer is China doesn't have the capacity to do that because the consumer is already weak. And the idea is, what's the next growth cycle? What part of GDP drives the next leg of Chinese growth? Because it's not going to be the real estate sector, the industrial sector has done a lot of work. The idea was that it was going to be the consumer, which is why you had dual circulation strategy, common prosperity, and it continues to essentially just flounder and really not drum up any new support. So keeping that in mind, you have to think about what we're about to talk about here. Since coming to power, China's President Xi had to deal with three overriding priorities. First, a domestic economy that is both slowing and increasingly unequal. Second, an adversarial geopolitical environment resulting largely from Xi's own quest to change the regional and global status quo. And finally, and most importantly, making sure he secures a third term as Chinese Communist Party's key 20th Party Congress next year. So how does he break the two-term limit? How does he manage a worsening geopolitical backdrop? All the while, inequality is spreading throughout the whole region. Again, looking at that PPI versus CPI. How do you pass on that producer price index into the export market if geopolitically people don't want to deal with you, and you start to see these pieces expanding? So over the weekend, the party's top journal released excerpts from Xi's speech on common prosperity. Again, looking at that common prosperity side, the inequality. Xi sounds a bit less like Mao when again, Trivium is providing some of this. He's not looking to bring back the iron rice bowls of the planned economy era. Instead, he wants to create an environment where entrepreneurs can thrive. Again, coming full circle to that AI patents. How do you incentivize entrepreneurs? Because you need to let them make money. Nobody's going to put the risk out if there isn't some reward on the back end of it. Common prosperity does not mean a neat and tidy egalitarianism. We must improve the people's ability to find employment and start businesses and strengthen their capabilities to get rich. The government cannot take care of everything. We must resolutely prevent ourselves from falling into the trap of nurturing lazy people through welfarism. But to be clear, this doesn't mean China's rich can breathe easy. Progressive income tax reform is clearly there based on this. We should reasonably regulate excessive income, improve the personal income tax system, and regulate the management of income from capital. Common prosperity will be the framework through which economic policy is made for the foreseeable future. While Xi has laid out the broad strokes, the details of common prosperity are being very hotly debated in Beijing. How those debates play out will determine China's economic future. And again, as we've talked about in previous shows, when you look at what is happening in general, you're seeing this reallocation and you're seeing this shift. And typically when you go into an economic hard period, especially in a communist country, as those from Russia and their satellites under the USSR can attest to, when economic hardships show up, you either become less communist or you double down. And when you look at what happened in the USSR, they doubled down to the point of breaking. And when you look at what has happened so far in China, they've doubled down. And that is going to become that underlying underpinning of pressure that we need to look at, which is why when we look at property developers are starting to see some of this, reaching this point, but we need to look at what is that debt going to do and how does it shake out over time as that PPI versus CPI spread is an anchor on that underlying growth as exports slow, as global demand diminishes, and they need to find another way to recoup some of those prices. So then when you look at something from the IIF, China's real retail sales normalized to 100 in Q4 of the preceding year. Again, value versus volume, you can see that there's just been a flat line. We are not seeing any type of acceleration in growth, and CPI is low. So it's not like we're seeing a whole heck of a lot as China's industrial production normalized to 100 in Q4 of the preceding year. You can see that, again, industrial production is now coming below 2015 levels. So you're seeing things get to well below 2015, and these pressure points continue to drum up, which is why it is very difficult to see any of this really play out in a meaningful way without some sort of economic slowdown, which is then when you start looking at new Chinese home prices month over month are now negative. China's new home price index saw its first monthly decline since 2015, which is why that 2015 number is so important for retail sales, for industrial production. The chart shows housing inventories as a share of total assets. When you look at inventory, Evergrande has this huge amount of assets that they can't sell and monetize, which again comes down to what is the value of the collateral and do they have enough to backstop themselves? So then when you look at authorities have discouraged domestic travel amid local outbreaks, that has continued to worsen. And again, there's a mixture of not only just, even though travel got somewhat close to normal in May, look at tourism revenue. You were still 25% off of normal and you were above normal on the number of tourists. Spending just isn't there and it keeps getting worse and is actually outpacing to the downside even with the restrictions on local travel. And that's why when you look at retail sales, you typically see retail sales accelerate into year end. And this is on a value basis. Again, remember, value versus volume, which is why we think that this is going to get worse. And they're actually going to cut into and do worse than what was in 2020 and 2019. So then when you look at the China industrial production, the survey was at 3.8%, actual was at 3.1, but we're below pre-pandemic. And this is the biggest problem, the pre-pandemic drop. Chinese manufacturing production year over year. You're seeing this pressure continue as again, what is the driving force of this economic growth that the street keeps quoting? Like, it doesn't exist. And that's where we start looking at things getting weaker. Markets were expecting a weak print, and they got something much weaker than that. So again, coming to what the expansion was, the slowdown was driven by a sharp moderation in activity in the key industrial sectors. Value-added output in the secondary sector increased by just 3.6% year over year, down from 7.5%. Power outages were one reason for weaker industrial activity, but a slump in real estate construction also took that down, with real estate floor space under construction fell 19%. The monthly econ numbers show that real estate is likely to remain a drag on the overall economy, with home sales falling 17%. And funding for real estate developers dropped 11.3% year over year in September, which led to a 3.5% year over year fall in real estate investment in the month. So again, now we're negative on this level, just something that has to be made up by other sectors of the economy. There remains virtually no sign of a policy response to take the edge off, and the two traditional channels of counter-cyclical spending remain weak. Infrastructure fixed assets investment fell 4.5% year over year, the fifth consecutive month of negative growth. Spending at state-owned enterprises dropped 1.6% year over year. All signs are pointing to a continued weak print in Q4. Now, the Politburo met and decided that the Central Committee's sixth plenum will take place November 8th to 11th. So gear up. We're going to have a lot to talk about. The Central Committee's annual plenums are the most important political gatherings of the year. They discuss all these different things. And what are they going to discuss? The title is Resolution of the Chinese Communist Party Central Committee on the Party's Major Achievements and Historical Experience of the Past 100 Years. Yay, party. Remember, doubling down on communism. The growth at all costs approach in the economy is out. Instead, the objective is more inclusive, higher quality growth. Politically, there will be no more toying around with liberal reforms. The party is doubling down on its Leninist roots. On the global stage, China is no longer hiding and biting. Instead, it expects Beijing to be more assertive in pushing its prerogatives and shaping global norms and rules. So again, we have a lot of pressure points to discuss. So then when we look at China fixed asset investment, again, just looking at where those pressure points are, we believe it'll be below pre-pandemic coming up. And then another big piece is the LGFV, or the local government financial vehicles. Bond net issuance continued to grow over the past 2 years. But remember, we've seen this come in below estimates, and they're trying to drum up more support because these are a huge drag on the local economies, local governments, which we've been talking about and we continue to see across the board. Chinese crude steel production year over year went through a floor as we ended September. We expect to see this remain low as we head in through October and start to pick back up as we get into November. And then when you look at the commodity building sales, total building sales came negative. Residential building sales again firmly negative as we continue to see a lot of these pressure points going forward. Proportion of property loans from banks versus non-bank lenders. Near record share of property loans in China has been outside the formal banking system, again giving rise again to shadow banking, which they have tried to lock down over the last 5 years, and now we're seeing it come back up as developers try to find other means to finance themselves in this tenuous time. Loans to developers declined for the first time in the past decade as they, again, trying to find other means of financing themselves. When you look at mortgages coming down, real estate loans coming down, but loans to developers now firmly negative. And what does that mean? Well, China credit splurge continues to tighten. And when you look at what happened with Japan in that time period, what happened to Thailand, Spain, and here's China, we're still at the precipice of this coming down. When you look at the private sector credit percent of GDP is starting to roll over. But as it comes down, again, you're going to see that consumer weaken and more of that come out in general, which is why when you start shifting into other areas of the region, we can shift to India. So the liquidity surge to sustain low deposit lending rates still remains there. They've put a pause on QE, but right now India is trying to maintain these low rates because they still need a lot of stimulus. They still need a lot of new money to come in, and this is going to become a much bigger overhang as we see inflation re-accelerating in October, and we expect it to come above their target. All the while, gasoline demand still remains is 8.3% over October 2019, 6.3% year over year. Then you look at gas oil. Gas oil is down 9.2% year over year, but only down about 1% versus 2019. With India's gas oil consumption fell in the first half of October from the same period in the previous year. Diesel sales by the country's state fuel retailers came in at 2.4 million tons during October 1st to 15th. So again, prices have gone up again, which to a new all-time high, putting additional pressure on some of those movements as we see some increase in imports and decrease in exports. So we do expect exports to reaccelerate. Imports are coming in. Again, India is an assembler and then exports either semi-finished or fully finished goods. This actually speaks well for some of that movement in general and some of that diesel demand as we go forward. And then, but at the same time, you see India wholesale price index, all commodities have come down. Excuse me. We actually see this accelerating again in October, just based on energy costs, food costs. They're trying to take down some of these prices, but we're actually seeing this go back up, which is going to be a pressure point for inflation in October and really into the end of the year. And one of the big drivers of that is when you look at imports, and this is looking at imports out for oil as terms of value, is at a new all-time high, which again is going to just feed into that inflation that is going to continue to be a driver through year end, which is not just in India, because then when you look at Korea, a developed market, the BOK is concerned about financial stability as the inflation, both core and headline, run above their inflation target. They've already raised rates, and there's a likelihood of them doing it once again to try to bring some of this inflation back in check and below their target. All the while, Japan's merchandise trade exports came in at 13%, down a bit, but still better than what expectations were. And then when you look at trade imports, they came down, still elevated. This still points to recovery in Japan with more exports to come, which will be a positive for their underlying economy. But when you start looking at the value of exports, they're coming down. And if you think of inflation, volume versus value, the export value coming down is going to be a little concerning in terms of, well, what is being exported? How much of that pricing that they're seeing internally is being exported back out, which again could be a bigger overhang as we go not only into Q4, but into 2022. So I know we covered a lot, especially in this segment. If you have any questions, you can find me on Twitter or obviously in the comments section. So we thank you again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.